Let's talk finances on this Friday night as we count down the time remaining in January, an up day in the markets on this final trading day of the month. Look at the indices all pointing up. The Dow up almost 400 points. The Nasdaq up over 100 points. S&P 500 47 points to the better. And even oil up 37 cents. The price of a barrel, $33.60. Still, with the up numbers, what's going down with your wallet and your investments? Well, let's talk about it now. And first of all, we bring on, Skyping in from San Diego, the founder and managing partner of Harrington Capital Investment, Kyle Harrington. And from Newsmax, Washington, managing director of ARC Financial Management, Robert Wiedemer. Bob is the co-author of the book Aftershock, Protect Yourself and Profit in the Next Global Financial Meltdown. So, Kyle, there you are out in sunny Southern California, and maybe the stocks just decided to rally for the weekend. We're always concerned about volatility. Do you expect the bumpy ride to continue, or are we going to see a more placid market in February?
No, I absolutely think that the market volatility will continue. I spoke about this last year, that I thought the last 6 months of the year and the equity markets would be volatile, and I think that going forward here in the first quarter of 2016, I think the marketplace will continue its volatility for an array of reasons. We don't have any real catalyst or underlying fundamentals that I think is going to make this market a more fluid market. You could talk about the jobs reports, you could talk about international turmoil, you could talk about oil prices being extremely low, and the fact that the United States has doubled its production and demand supply is there, and the prices are down significantly. Any of those measures you can speak about, and I think it's going to be a volatile ride.
Fair enough, Kyle. Since you mentioned a variety of different things, let me concentrate on the way we keep track of things. And since, Bob, you're sitting there in Washington, I always view some of these numbers with the current administration in charge. Somehow I feel the numbers are kind of like counting votes in Cook County, Chicago. At any rate, the Commerce Department measuring the fourth quarter, they said the gross domestic product increased at a 0.7% rate. In the third quarter, we saw a 2% increase. Now, I don't know if it's monkeying with the numbers, but why the sudden economic slowdown, according to the latest numbers from Commerce?
Well, you're absolutely right about numbers from D.C. It's not that different from Chicago, where, of course, the motto is vote early, vote often. I would say that for this time it's for real. I mean, we've been seeing other numbers that have shown a slowdown in the fourth quarter. Trade in particular, exports are not doing well. Manufacturing's been in a recession. The oil industry is having trouble. Consumers are not spending quite like they used to, at least in the fourth quarter. So I think it's legit that it's down. It's interesting, though, that in the past they always say that it's the first quarter seems to be down and all the rest of the quarters are good. Now it looks like the fourth quarter is not so good and the first quarter is not so good. Pretty quick, this is starting to look like a much slower economy in reality.
And it adds up to being not so good, and that's put it mildly. Kyle, since you're there on the banks of the Pacific, let's go clear across to Japan as the Japanese try to bring their economy back to prosperity. Earlier today, the Bank of Japan saying it's going to put interest rates into negative territory in order to preserve their stock market. Their trading was in the positive today, but what long-term effect does that have for the Japanese and for us?
Well, you could just tie this into this being a market that they're trying to create some momentum in the equity markets by artificially jiggering around interest rates in Japan. And by the way, it's not so far off to what we're doing here in the U.S. And so our interest rates are extremely low. How low do we go before the marketplace reacts in a positive way? I think long term, we want to depend on natural markets with natural supply and demand, good corporate earnings, a healthy jobs market versus the Federal Reserve or monetary policy dictating which direction we go in. And this is an example of they're going into negative territory in order to create demand in their equity markets.
Yeah, negative territory. This is just like down is up is down, and everything gets confused. We've got about a minute and a half left. We've talked about energy before. We could spend time on that topic, but I'd like you gents to devote your energy to what investors should be doing now. Bob Wiedemer, let's start with you for about 30 seconds.
Sure. One, I'd be a little careful about jumping into the energy stocks right now, thinking we're on a big rebound. There's been rumors that Russia and Saudi are going to cut production. Not going to happen. Iran had just said they're not going to cut production until they increase it by 1.5 million barrels. So I'd be a little bit careful about jumping on that one. I think we haven't seen the worst yet for oil. And I would be careful about the stock market in general until we see the Fed print money again, which I think will happen, but it's going to be volatile until then, on the downside.
All right, Kyle, give us the view from the left coast. What would be the right move?
I'll tell you, I happen to agree with Bob 100%. I'm not so sure this is the right time to jump right in and start accumulating huge positions in oil and gas or oil and gas service-related companies. Does a portion of your portfolio, is it meant to be allocated to the energy sector based on your individual risk tolerance? Potentially, but I would be careful about jumping in the market. Maybe you edge your way in here. But I certainly don't think that oil and gas is going up anytime soon in a significant way.
Gentlemen, you were both cooking with gas, so to speak, in terms of your analysis of the days ahead. Kyle Harrington in San Diego, Bob Wiedemer in Newsmax, Washington. Thanks again. Bob's book is Aftershock, Protect Yourself and Profit in the Next Global Financial Meltdown. Up next, Andres Simone to talk about refugees.